So students, now we will look into this particular question number 38, students. One of the beautiful questions, students. One of the beautiful question number 38. Let's have a look, students, on this particular part. Thereafter, Vioni and C dot. Let's now look about students question number 38. One of the beautiful question. Vioni and C dot, a company incorporated in Japan, is engaged in development of infrastructure and providing the consultancy in the same field. During the financial year 22-23, its shareholder met in India for the 3 times. Students, the first 2 meetings were held to discuss. The first 2 meetings, students, so the first 2 meetings, students, were held to discuss the modification of rights attached to various classes of shares, and the third meeting was held to discuss and decide about sale of companies assets situated in India. It provides the following additional information pertaining to the financial year 22-23. Now students, this is a foreign company which is based in Japan. That is for sure, which we can easily make it out. Question therefore is, if it is a foreign company and going by this particular paragraph, one has to decide whether its poem can that be considered to be in India, whether its place of effective management can that be considered to be in India. Because if you say that its poem by virtue of this particular paragraph, is in India, then in that particular case, students, you would be aware that then it will become a resident in India. So that is the larger issue that needs to be discussed. See, the place of effective management depends upon what? Two things. First, one important thing, which is about whether the foreign company fulfills the active business outside India test. The active business outside India test, which implies this, that they need to have their passive income, students. They need to have their passive income, students, in this context. They need to have, students, their passive income. In this regard, a passive income in this particular context, which should not be more than 50% of the total income. So what is required, students, in this case is the fact that the passive income should not be more than 50% of the total income. That is the point, students, which has been there in this regard. That is the point, students, which is there in this regard, isn't it? So this is what it is in this context. So students, over here, if you all now see very carefully, check the total income details, students, from this. What are the various income that it has earned? Quickly, students, read this one. So let's have a look, students. So in this, if you see, there are all the passive income. You can easily make it out, students. There is no business income which has been earned by this foreign company in India, Archana. So the fact that in this case there is no business income, so we can easily say in this context, we can easily say in this particular context that the passive income, students, the passive income we can say is more than 50% of the total income. Is more than 50% of total income. Can that be concluded? Yes, it can be. The passive income, students, is more than 50% of the total income. That definitely can be concluded, students, in this regard. Now, with that particular proposition, with this, wherein we say that the passive income is more than 50% of the total income, then it means that the active business outside India test, that is not fulfilled. This particular test, students, is not fulfilled. And if this is not fulfilled, then in that particular case, what does the concept says? So far as the poem is concerned, then if the foreign company which do not satisfies the active business outside India test, in that particular case, all such foreign company, students, all such foreign companies poem will depend upon who is that person who is taking key commercial and managerial decision for that foreign company. Who is that person who's taking the key commercial and managerial decision for that particular foreign company? And point number two, when that decision is taken, sorry, where that decision is taken. So it is the who and the where, on the basis of which the poem of that foreign company will be decided. And if that who and where happens to be in India, the who and where happens to be in India, then in that case the poem of that particular foreign company will also be students considered as the poem of that foreign company. If that happens to be in India, then in that situation, students, that foreign company would be a resident in India. Okay, so that who and where therefore is important. Now coming back therefore in this particular context, students, over here, what it says is that its shareholder met in India for 3 times. The first 2 meetings were held to discuss the modification of rights attached to the various classes of the shares, and the third meeting. So in this case, 2 meetings primarily, students, out the 3 meetings they have said that they have held, and first 2 meetings were held to discuss the modification of the rights attached to various classes of shares, and the third meetings were held to discuss and decide about the sale of companies' asset situated in India. Please tell me then, do you think that these kind of meetings are something to do with deciding where the key managerial and the commercial decision is going to take place? Are they about commercial and the day-to-day management of the company? Is that the meeting for all about? Is this the meeting for those commercial and day-to-day managerial decisions of that particular foreign company? Answer is no. So this has to do with something about the shareholders' right and disposal of some of the assets which is situated in India. Nothing to do with the commercial and the day-to-day managerial decisions in India, and therefore we can say that the foreign company, which is Vioni Inc. dot, which is not satisfying the active business outside India test, but at the same time, in this case, the key managerial and commercial decision is also not taking place in India. The key managerial and the commercial decisions of that foreign company is also not taking place in India, and therefore what? Therefore, the poem of that particular foreign company, is outside India. The poem of that particular foreign company, students, is outside India, students. And if it is outside India, it is a non-resident. So this is how you have to conclude first that it is a non-resident. And once it is a non-resident, students, we all know that only 2 incomes of that non-resident will be deemed to accrue as in India. Sorry, the 2 income of that non-resident will be chargeable to tax in India, and those 2 incomes are: number 1, income which is accrued or deemed to have accrued or rise in India, and the second one is the income which is received in India. So let's have a look, the income accrued or deemed to have accrued in India. Let's see from this one, and the second one is income which is received in India. Dividend declared by Miyani Inc. dot, a Japan-based company, 54,000. Now, students, in this case, this is a foreign company which is declaring the dividend. And the foreign company declaring the dividend to whom? To Vioni Inc. dot another foreign company which is a non-resident. Now they are also telling you students over here in this particular context that Miani Inc. dot holds 70% of its total assets in India. So technically speaking, students, remember that indirect transfer, in which case you would know that if a foreign company, if the foreign company derive its value substantially from the Indian asset, if the foreign company derive its own value substantially from the Indian asset, then the shares of that foreign company, the shares of that foreign company is also deemed to be situated in India. The shares are situated in India by their fiction. The shares are situated in India by the fiction, but it still remains a foreign company. The shares of that foreign company is deemed to be situated in India, but it still remains a foreign company. Do you all agree to this one? And that exactly is the point. Now in this particular case, students, now in this particular case, what do we say? In this particular case, students, what do we say? We will say this, that be careful, students, that this is still a foreign company which is giving the dividend to whom? To another foreign company, Vioni Inc. dot, and Vioni Inc. dot is a non-resident. So therefore the dividend, if Vioni Inc. dot is receiving from another foreign company, then whether that particular dividend, will it be deemed to accrue or rise in India so far as Vioni Inc. dot the recipient is concerned? Whether it will be deemed to accrue or rise in India so far as Vioni the recipient is concerned? Answer is no. Why? Because we have seen primarily yesterday as per section 914 that the dividend income will be deemed to accrue or rise in India. The dividend income will be deemed to accrue or rise in India if and only if, students, that the the dividend income will be deemed to accrue or rise in India if and only if, students, it is received from an Indian company. It is received from an Indian company. Whereas in this particular case, since it is received from a foreign company, therefore no dividend is deemed to have accrued or arise to Vioni Inc. dot. So if it is not deemed to have accrued, this particular dividend income will not be considered at all. This dividend income will not be considered at all. Coming to point number 2, in the computation of the total income. Now, fees for technical service received from Government of India, rupees 4,54,000. The Government of India utilized such technical service for development project carried out in Nepal. What did we discuss yesterday? If the Government of India is a payer of interest or royalty or fees for technical service, and to whom that they are paying to the non-resident or to a foreign company, then in that case the amount so received, namely interest, royalty and FTS, will always deem to accrue as in India, irrespective the purpose for which the government is making the payment of these three amount. Irrespective of the purpose for which the government is making the payment of this three amount. And that is what, students, the point is in this regard. So fees for technical service received from Government of India, rupees 454. The Government of India utilized such technical service for development project carried out in Nepal. Now interest received from Mrs. O. So therefore, students, is it deemed to accrue as in India? Answer is yes. So will I be considering it in computation of total income? Again the answer is yes. Come to point number 3. Interest received from Mrs. O, a unit located in IFSC, in respect of money borrowed. Unit located in IFSC in respect of money borrowed by Mrs. O, 15,400, students. Are you aware of this particular point, students? There is an exemption which is there under section 1015. Beautiful exemption. And what that exemption says? That exemption says that if students, if the loan has been borrowed, students, if the loan has been borrowed by a unit in IFSC, from whom it has borrowed the loan? It has borrowed the loan from whom? From a non-resident. And therefore, because of that loan, the interest is paid. Therefore, because of that loan, the unit of IFSC is paying the interest. Now here, students, very importantly, we need to know what is the date of loan. What is the date of loan? And if the date of loan is after September 19, after September 19, then in that particular case, the interest income earned by the non-resident, the interest income earned by the non-resident Pusha, it is exempt. And that exactly is the point. That exactly is the point. So therefore, will it be eligible for exemption? The interest income answer is yes, because the date of loan is 24th of December 2022, whereas the exemption applies when the loan has been given from September 19 onwards. If the loan has been given in that particular case, all the interest income arising out of that particular loan will be eligible for exemption. Come to the next particular point number 4. Point number 4, students. 26th of August 2022, Vioni Inc. sold 5,000 equity shares held by it in an Indian company for rupees 89 per share. So, in this context, students, Vioni Inc. sold 5,000 equity shares held by it in an Indian company for rupees 89 per share. So students, in this particular case, obviously you are transferring a shares of an Indian company, and the fact that you are transferring the shares of an Indian company, the capital gains arising on such transfer, will it be taxable? And the answer is yes. Please have a look to this particular proposition. These shares were bought by Vioni Inc. when? On 28th of June 2012 for rupees 64 per share. Both the purchase and the sale were effected through a recognized stock exchange in India. Fair market value of these shares on 31st of Jan 2018 was rupees 70 per share. So therefore this share is acquired in 2012, and accordingly we can say it's a long term. And because it is long term and the fact that it is purchased and sold through a recognized stock exchange, it will go under 112A. And 112A primarily will be made applicable in this case. And if 112A would be made applicable in this case, students, the full value of consideration is the amount that you have received in this context, and the amount that you have received is 89 per share. 89 per share, students. And thereafter, students, what would be the cost of acquisition, students, over here? Please calculate and tell me what would be the cost of acquisition in this particular case. The cost of acquisition, students. And the cost of acquisition, students, you could know. In the case when 112A is applicable, primarily the fair market value as on 31st of Jan 2018, the fair market value as on 31st of Jan 2018 needs to be looked upon, which is rupees 70 per share. And is it more than the cost of acquisition? Is it more than the cost of acquisition? Which is yes, because cost is 64, whereas the fair market value is on 31st of Jan 2018 is rupees 70 per share. So yes, it is more than that, students. And accordingly, students, what we are going to say, that 70 rupees is what would be reduced as a cost of acquisition. 19 is the final particular, the capital gains per share into number of shares, students, into number of share, which is 5,000 shares, and by virtue of which you will get the total capital gains. From this, 112A exempts 1 lakh. 112A, students, exempt 1 lakh, and then thereafter, students, the balance amount would be reflected. One of the beautiful questions, students. Okay, so let's now look upon, students, to the next particular case. Students, just again, I'm just letting you know point number 3 over here. Be careful, because this is a new amendment, this is a new exemption, which many of you may not be even aware of it. So let me in fact bring down to this point number 3 again. What point number 3 says? First of all, who is the borrower? The borrower is a unit which is located in the IFSC. From whom the loan has been borrowed? From whom the loan has been borrowed? From a non-resident or a foreign company. When the loan has been borrowed? September 2019 onwards. If all these three conditions are satisfied, then the interest on such loan earned by the non-resident or the foreign company will be eligible for a full exemption under section 1015. And therefore, in this case also, because the loan is borrowed on 24th of December 2022, therefore we say that the interest income will be eligible for a full exemption. Is that point clear to all of you? That exactly is the point. Students. Now, students, question 39, point number 1. Students, we will be discussing a bit later this, not right now, but later on we will discuss this particular proposition in this context. Please come to this particular part, the second one. The second one, students. All of you. No PE condition. Which of the answer is correct in this MCQ number 2? Point number 2, students. MNO-INC dot and PQR-INC dot are two country M based companies engage in trading of oilseed. So both of them are foreign company. MNO-INC dot sold oilseed of value 1.8 crores during the previous year 22-23 to XYZ Limited, an Indian company, through an agent in Delhi who secures the order in India mainly for MNO-INC dot. Mainly for this INC dot. Now, if you see the further particular point, students, over here in this context, what it says. So obviously, students, there is a business connection for MNO-INC dot sold. So there is a business connection, students, in this particular context, isn't it? Now, going further in this regard, so there is a business connection, at least for, we can say, in this case, the MNO-INC dot has got a business connection in India because it is selling the goods through its agent in India who is securing the order for MNO-INC dot. Now, PQR-INC dot also sold oil seeds of the value 2.1 crore during the previous year 22-23 to XYZ Limited through an independent agent carrying on agency business in Mumbai. In this context, so therefore over here we can say Primary. So there was, in this case, their MNO was having the agent, and through that agent, students, we have said that what we have said, that yes, there is a business connection, because this agent primary who has sold the goods of MNO Inc. dot, to whom he has sold the goods were being sold to XYZ Limited. So this particular agent primarily has sold the goods of MNO Inc. dot, and that too because of what reason? The reason is very clear, that he has secured the order mainly for MNO Inc. dot only. So that is what is the scope of work. But the second non-resident, which is PQR Inc. dot, has an independent agent in India through whom he is selling the goods to XYZ. And because he is an independent agent, not a dependent agent, we have seen yesterday that this will not be considered as a part of the business connection in India. The business connection primarily is not, because of this reason, there is no business connection. But please understand, students, the fact that the value of the goods is how much that he has sold in India. In the second case, the value of the goods that has been sold by PQR through that independent agent, and that sale is in India. So that is 2.10 crore, more than 2 crores. Can we therefore say that PQR INC dot has got a significant economic presence in India? Can we say therefore that PQR INC dot has got a significant economic presence in India? Answer is yes. So they have a, although they don't have the agent P, they don't have the agent P business connection, but the fact that there is a significant economic presence, therefore there is a business connection of PQR INC dot in India. Therefore, there is a significant economic presence or business connection of PQR INC dot in India. So both of them has a business connection in India, but for different reasons. Both of them has got a business connection in India, but for different reasons. Thereafter, they are saying the independent agent in Mumbai renders service to mainly other oilseeds trading companies which are not related to PQR INC dot in any manner. Both MNO INC dot and PQR INC dot does not have a P in India. That's fine, but we have already concluded that even though you may not have your P, but do you have a business connection in India? Answer is yes. Examine the taxability of income earned by MNO Inc. dot and PQR Inc. dot from their sale transaction with XYZ Limited based on the provision of Section 9(1) of the Income Tax Act 1961. Ignore the DDAA if any. Can we therefore say the A is the correct answer? Krishna, Ramkumar. So therefore, students, can we therefore say that the A is the right answer? Yes. And that exactly is the game, students. Yusha, Hitesh. And that exactly is the game, students. Let's now look upon to the next particular question. The next particular question, students. TINC dot country X advanced $10 million on 1st of June 2022 to KS Private Limited India in foreign currency. KS Private Limited accepted the loan amount under an agreement approved by the central government of India. So obviously this particular case of the non-resident primary TINC dot has advanced a loan of 10 million to an Indian company which is KS Private Limited in foreign currency. Remember this part, because 115A, always keep in mind that. KS Private Limited accepted the loan amount under the agreement approved by the central government. The loan carries interest at 9% per annum, payable in foreign currency. So payable in foreign currency has got no relevance. What is important is that the loan should be taken in foreign currency. That is more important. How the interest would be payable, that will not decide the destiny of 115A. 115A only talks about that if the loan has been given in foreign currency, then the special rate of tax of 20% under 115A will be applicable. Now the loan carries the interest of 9% payable in foreign currency for financial year 22-23. KS Private Limited paid interest after deducting income tax on 31st of March 2023. The TT buying rate on 1st of June 2022 is 1 US dollar equal to 69. On 31st of March 2023 it is 1 US dollar equal to 70. What is the income tax liability, students, of TINC dot in India for assessment year 23-24 in respect of interest income earned in foreign currency for KS Private Limited? Now you realize, students, how important was the first class? Important was the first class? Because in the first class I have drilled down the concept for all of you, and because of those concepts that these questions becomes now appreciable. Now if you see probably over here in this particular context, what has happened, there is a foreign currency we need to convert into INR. There is a foreign currency and we need to convert that into INR, students. And therefore if we have to convert into INR, which is the TT buying rate which we are going to take? So I told you yesterday that for income, namely salary income, the interest on security, third is a dividend, and fourth is the capital gains. For these four income, we take the TT buying rate as on the last date of the preceding month. The TT buying rate as on the last date of the preceding month. Preceding to which month? The month in which it became due or it has become accrued. It became due or it has accrued, students. And therefore, students, in this particular context we will go this in this case this is the interest on borrowing and not the interest on securities. And because it is an interest on borrowing, for all the remaining cases of income like house property, PGBP, or interest other than the interest on security, for all the remaining income it is the 31st of March. So we will go with 31st of March. So now, students, if you see how much interest at 9%. So first of all, loan is 10 million into 70. Okay, into interest 9%. Into, for how many months, students? From June you have to calculate 9 by 12. So can you tell me in INR, students? INR in this case will be how much? So 10 million is 1 crore. 10 million, students, would be 1 crore. So 1 crore into 70 would become 70 crores. So of 70 crore, students. So of 70 crore, students, in this particular case, 9%. 9% becomes 63 lakhs, students. Oh no, 6 crore 30 lakhs. 6 crore 30 lakhs is the interest. Okay, for full year into 9 by 12. Into 9 by 12. This is 47 lakh. Oh, sorry. 4 crore 72 lakhs 50,000. 4 crore 72 lakh 50,000. And now the tax rate would be 20%. 20% of this. Oh, sorry, students. 10 by 12. Students, 10 month. Ramkumar. Indeed. It is 10 by 12, students. It is 10 by 12. Why 10 by 12? You should be aware of this one, students. Why 10 by 12? It is from 1st of June. So therefore, what is the answer in that case? If it is not 9 by 12, if it is 10 by 12. Because from 1st of June, these are the silly mistakes that the ICI is waiting for. So 10 by 12, students, would be how much? Why 25? 5 crore 25 lakhs. And of that, students, take 20%. which is 1 crore 50 lakhs, 1 crore 50 lakhs plus surcharge. Will it be applicable? Yes. More than 1 crore, the income is more than 1 crore. It is 5 crores the total income. So surcharge would be applicable, and therefore 20% would be the surcharge. Sorry, 2% would be the surcharge on this. So in this case, it becomes how much? 2,10,000. Add to this, it is 1 crore 7 lakh 10,000. 1 crore 7 lakh 10,000, and then HEC of 4%. HEC of 4%, students. And therefore, in this case, it becomes 111,38. Answer is C. And that exactly is the game, students. That exactly is the game. I hope that all of you are clear with this one. All of you are clear with this one, students. So this is how the things has to be looked upon. Be very careful. These are all calculation sum. Getting a silly mistakes are very easy. Now let's look upon to question number 40, students. This is one of the beautiful questions, students, based on the latest amendment. Many of you are aware of this one. Many of you are aware of this one. Please read this question carefully. So if you see, students, question number 40, matrix INC dot incorporated in country X holding 26% of controlling interest in PLU Limited, an Indian company. PLU Limited declared dividend of 50 lakhs during previous year 21-22. The DTAA between India and country X, students, in this context. Now, students, tell me one thing, whether the transfer pricing provision should it be applicable in this particular case of declaration of dividend to your non-resident associated enterprise? Why this is an associated enterprise? Because if you know the definition of associated enterprise, if the foreign company has at least 26% of the voting power in the another company or vice versa, then in that particular case we can say that both the entities are associated enterprise. So obviously Matrix and PLU Limited are the associated enterprises, and PLU Limited is declaring rupees 50 lakhs as a dividend, and therefore the question is, in this particular case, whether the transfer pricing provision could it be made applicable for the dividend which is paid by PLU to whom? To Matrix INC dot. Whether the transfer pricing provision could it be made applicable in this regard, students. In this particular context, students, please understand that transfer pricing provision will not be made applicable in this case, and the reason is very clear. The transfer pricing provision to be made applicable requires an international transaction, students. Requires what? An international transaction. So, do we have this as an international transaction? Answer is no, students. There is absolutely no international transaction in this case. And why do I say so, students? Why there is no international transaction? The reason is very clear, that there has to be a transaction. Is a declaration of dividend, is it a transaction? No. It is a consequence of a shareholding. Because you are a shareholder in my company, therefore the resultant consequence is that I have to declare the dividend. So it is not that I am doing a transaction, it is actually a consequence arising out of, or an obligation arising out of the declaration of dividend. And the dividend is not only declared to matrix, it has to be given to all the shareholder. And to the extent of shareholding of matrix, that much of the dividend would be paid to matrix, and the remaining to the other shareholders. So therefore there is no international transaction that has taken place by PILU Limited with whom? With Matrix Inc. Dot. This is not a transaction which we both have entered. No, we are giving the dividend to all the shareholders, and whatever is the extent of your shareholding, that much portion of dividend would be given to you. So there is no existence of a transaction by PILU Limited with Matrix Limited, and hence the transfer pricing provision in this case will not apply. Now, Matrix definitely has earned dividend in this case from an Indian company, and because it has earned the dividend from an Indian company, therefore as per 914 the dividend income will deem to accrue arise in India. And we also know under the Income Tax Act the tax rate is 20% on this particular dividend amount. But then what they say, that there are two treaties now. Please be careful, students, over here. The DTAA between India and country X. Country X is which is the country where Matrix Inc. Dot was incorporated. So the DTAA between India and country X, which came in force on 1st of Jan 2018, provides for taxation of dividend at 15%. So it has a taxation of dividend at 15%, students. And because of that reason, students, because of that reason, students, because of that reason, students, you will refer the treaty between India and country X. You will refer the treaty between India and country X. And what is the treaty rate, students? What is the treaty rate, students, in this particular context? The treaty rate, students, in this particular context over here, if you see very carefully, is 15%. But then what Matrix is finding out that with another country, which is country Y, the treaty rate for the dividend income is how much? 10%, meaning lower rate. And country X is a member of OECD from 2015, whereas country Y is also a member of OECD from 2017. So both of them are, students, the member of OECD, and there is a protocol which is annexed to India DTAA with all the OECD member country. And what is that treaty? What is the protocol? The protocol is of the parity clause. What is this parity clause, students? Are you aware of this particular parity clause, students? The parity clause, students, as you all will see very carefully, as you can see, students, very carefully, for parity clause, what it says in this regard, that if both of them are the OECD member, and if both of them are the OECD members, then parity clause says that if the rate is say 15%, if the rate is set 15% in one case, then the next treaty, if you have entered the next treaty, that if you have entered with another OECD country at a lower rate, which is 10% in this example, then as per the parity clause, we would be we should be in a position to get the access of that treaty where there is a lower rate. We should be getting the access of that treaty which has got the lower rate. This is the parity clause. So therefore, in that case, matrix X, which is though incorporated in country X, wants to get the access, students, wants to get the access of the Treaty of India with country Y, where the treaty says the rate of tax of dividend is only 10%. So whether matrix can they get access, whether the matrix can they get access to that particular treaty clause? To that the answer is yes. They can get the access to the country-wide treaty, but for that there are some conditions, students. And what is the condition? Condition number one: both students, both of them, meaning thereby country X and country Y, should be the OECD member. Should be the OECD member. Are they the OECD member, students? Answer is yes. In this case, the other condition is this, that students, the country-wide treaty which you want to invoke, the country-wide treaty which you have to invoke should have come into effect after the country X treaty. So therefore, the country-wide treaty should have come into effect after country-wide treaty. Sorry, country X treaty. So is that condition is also satisfied? Yes, because first was country X, no? And the country X was 1st of Jan 2018 and country Y was 2015. And the third condition, students, is very carefully, students, both of them are the member of OECD. So OECD, students, so they the second country, mainly the second country, students, both of them, and mainly the second country for whom you want to get an access, probably OECD member as on, they should be OECD member as on which date? 15th of May 2018. Why 15th of May 2018? Because that was a date, students, in this particular context. That was a date when the country-wide treaty came. So on that day when the country-wide treaty came, they should have been the OECD member, students. They should have been the OECD member. So therefore the question to all of you is, both of them, are they the OECD member as on 15th of May 2018? And the answer is yes. How do you say? Because country X became the OECD member in 2015, whereas country Y became the member in 2017. So both of them are the OECD member as on 15th of May 2018, and hence even this condition is fulfilled. But whether your answer will change if country Y has become an OECD member only in the year 2010, means the treaties entered, country-wide treaties entered on 15th of May 2018, but it became the member on 2020. So if it became the member in 2020, OECD member, but this thing is, the treaty shows, the treaty in this case of India and country Y has been entered in the month of May 2018. In that particular case, students, this condition is not fulfilled, and if this condition is not fulfilled, then matrix Inc dot, the company based out of country X, will not be in a position to invoke the treaty of India with country Y. The treaty of India with country Y, and that exactly is the point, students. That exactly is the point. So this is what, students, it is all about in this regard, students, in this context. Now, this is a practical question, students, for which the solution would be given it to all of you for the homework question, students. We now deal with, students, beautiful question. We'll now deal with some beautiful question, students, in this regard. In this regard, students, please have a look at this context. Therefore, in this scenario, provision, students, question number 42. Read the question very carefully. One of the most likely question for your examination, most likely, students, is this question number 42. Students, please solve it and try to get your answer on this. I just need to know what is the answer. Don't only sit idle, you need to solve also. Only then you will be in a position to get a benefit out of it. Krishna. So students, I hope that all of you would have solved it in this regard. And therefore, in that scenario, students, let's take the discussion forward. Let's take the discussion, students, forward in this case. So, going by this particular proposition, what it says in this scenario. So, KP Limited has sold the goods on 13 December on 13 December 2021 to LM Limited, located in the notified jurisdictional area. Students, be careful. Located in the notified jurisdictional area. Okay. Now, students, in this case, in this particular case, students, what we can say over here, students, the SSC has sold goods on 13 December 2021 in this scenario. 13 December 2021, students, in this scenario. So therefore, students, in this particular case, what we can say, both of them, students, both of them can we consider now, students, both of them are deemed to be an associated enterprise. Are you aware of that position, students? Kalai, deemed to be an associated enterprise, can we say that? Answer is yes. Answer is yes, students. So they are deemed to be, students. So students, I think the video got hanged. I hope that now the things are fine. The things are fine, students. The video got hanged, students, because of the internet part, but I think now it is fine. Perfect. So now in this particular context, during the current financial year, KP Limited has charged 12.6 crore from XY of US and 13.2 crores from RS of London for the sale of identical goods. So who are these two? In this case, XY and RS, they are the comparable, students. Gayatri, they are the comparable, students. So therefore, in this particular case, they happen to be the comparables of the identical goods, and both of them are neither an associated enterprise, that we all know. So both of them are neither the associated enterprise of KP nor they are situated in the NJ. Now while the sale to XY, students, and RS were on CIF basis. So therefore, students, in this particular case, while the sale to XY and RS were on CIF basis, the sale to LM Limited was on FOB basis, students. FOB basis. And because of that reason, students, you would also appreciate that one was a CIF and another one is the FOB. So obviously the comparable was at CIF, but the international transaction is at FOB. So what we need to do in this case, we also now need to, students, convert the CIF value into the FOB value, students. We need to convert the CIF value into the FOB value. Convert the CIF value into the FOB value, students. Do you all agree? Because, why is it so? Because of the fact that this was at FOB, because of the fact that the international transaction is at FOB. Ramkumar, the international transaction was at FOB. Therefore, the identical transaction, the comparable transaction also needs to be at FOB. So, we will then convert it into FOB. So, in this case, how do we convert it into FOB? Let's see. Was it FOB which paid Ocean particular context? The KP Limited has sold it in at CIF price for these two, and in that CIF price 20 lakhs was for insurance and freight. So I need to then have to remove this particular insurance and freight. By removing the insurance and freight, I come to 12.4 crores and 13 crores. After removing, it is 12.4 crores and 13 crores. Students, in that case, you have two comparables. And which is the method that you are applying in this case? You have a two comparables, and which is the method that you are applying to determine the ALP? The method that you are applying is the cup method. And because the method that you are applying is a cup method, therefore, students, now you need to take the average. So, students, 12.4 plus 13. 12.4 plus 13, which is 25.4 in this particular case. So 25.4 divided by 2. Divide 25.4, students, divided by 2 in this case. How much is this for, students? $12.7, students. Average is 12.7. So this is the average. So if there is a cup method and the comparable size is less than 6, then the ALP which we have determined, we need to average it out. Then the ALP that we have determined has to be averaged out. We have also done the average, and the average, student, in this case is 12.7. The average, student, in this case is 12.7. I hope that all of you are clear with this one. Now the question is, will we do this particular part? If you remember, students, that 12.7, which is the average ALP, and then what is the transfer price? The transfer price, students, transfer price is 11.4. How much is the difference? In this case, the difference, as you can see, students, is 1.3. Do you know, students, we do this thing 1.3. There's a 3% tolerance band, that up to 3% of the transfer price, if the difference is up to 3% of the transfer price, then we will ignore the difference and we will accept the transfer price. If the difference is up to 3% of the transfer price, then we can ignore the difference and we can tolerate the transfer price. Is that 3% of tolerance band? Is that 3% of the tolerance band? Can that be considered? And the answer is no. That 3% of the tolerance band concept will not be applicable. It is not applicable, students. Are you aware of that? The 3% of the tolerance band is not applicable, students. Why it is not applicable? Because if the transaction is with the NJA, if the transaction is with the entity located in the NJA, then yes, all the transfer pricing provision will be applicable in respect of that transaction. All the transfer pricing provision will be applicable in respect of that transaction, except for one. And what is that one? This particular concept, wherein the difference that we get, we compare the difference with the 3% of the 3% of the transfer price and see whether the difference exceeds 3% of the transfer price or not, this concept will not be made applicable over here. This concept will not be made applicable over here, students. I hope that all of you are clear with this proposition. And that exactly is the point, students. And therefore, in this particular case, this will not be considered. So this concept will not be applied, and therefore 1.3 is the addition which would be made on account of addition in the total income. Addition in the total income on account of what? On account of the adoption of the transfer pricing provision. Oh, sorry, one more thing is there. I just forgot, students. One more thing. Okay. So I just forgot that reading that point. Students, one more point was there. How could you all forgot, students, this particular point? Even this point is there. We only were doing the CF. There was other point also. India has DTAA with US and UK. After that, what they have mentioned? The SSE has a policy of providing after sales service to the tune of 12 lakhs to all the customer except LM. Means except LM means except the entity located in the NJ who is deemed to be my AE now. So except to that entity, to all the other entity, the price charge to all the entity, the price charge is come warranty price, or may I say the price charge is inclusive of the after sales support. So for all the entity except for the entity which is located in NJ, which is considered as my deemed A, all the remaining entity, I am charging a price which is inclusive of after sales support service. So therefore what I need to do? I need to remove this element so as to bring it par with that of the terms of the price which I have charged to whom? To the entity located in the NJ which is deemed to be my A, and therefore what students? I am going to exclude that rupees 12 lakh as well. So students, in this particular case you need to exclude, so not 12.4, you need to keep excluding even 12 lakhs. You need to keep on excluding, students, rupees 12 lakhs as well in both the cases. In both the cases, students. Is that point clear to all of you? So minus 12 lakh students in this case and minus 12 lakh students in this case. So now can you give me the amount, students? Hear it? So 12.4 minus 12 lakh students in this scenario, and 13 crores minus 12 lakhs. How much is the amount? Respectively 12.28, and the second one, students, is 12.88. 12.88, no? Second one. First one is 12.28 and another is 12. This thing. So do add these two and thereafter divide it, and finally, students, are you getting 12.58? Are you getting 12.58? Nivedita? And therefore it is 12.58, which is the average, minus 11.4, and therefore finally, students, in this case 1.18 is the addition. 1.18 is the addition that we have to make, students. Is that point clear to all of you? Hitesh? So this is a game, students, that has to be played very properly. Now 43, question number 43, students, unfortunately this is for the partnership assessment, which is something we are going to discuss later on, not right now. Let's only focus on the transfer pricing provisions. Now with this, students, see, this is also same question, students. So students, this is the same. See, just imagine ICI has put up this question 2 times by virtue of different names, but the same concept. 2 times, students, but not yet asked in the examination. Not yet asked in the examination, and therefore I say in all the probability In all the probability, no TDS Hitesh. In all the probability students, this could be one of the most likely question that could be there in your exam. Because last time students, they have asked the question on cost plus method. So they will not repeat that particular method, but definitely they will repeat this sort of a concept. Now, students, the next question is that of a thin capitalization, students. The next question is about a thin capitalization. Even a thin capitalization concept is very important, 94B. Students, as you may be aware, in the case of the thin capitalization, I hope that all of you are aware of thin capitalization. Now, what happens students, in the case of thin capitalization? I think that all of you are aware of it. That if you have borrowed the loan from your non-resident A, if you have borrowed the loan from the non-resident A, or point number two, what is point number two, students? Or point number two, first is you have borrowed the loan from the non-resident A, or you have borrowed the loan from a third party. You have borrowed the loan from a third party, which is guaranteed by, guaranteed by whom? Which is guaranteed by the non-resident A. Okay, and more importantly, students, and the assessee is not engaged. The assessee is not engaged in the banking business. In that case, if the interest paid exceed rupees 1 crore, if the interest paid exceed rupees 1 crore, in that case, the provision of section 94B will be applicable. And what is the provision of section 94B? It says this, that the interest expenditure that you have paid to your non-resident AE, that interest expenditure would be compared with 30% of EBITDA. That interest expenditure will be compared with 30% of EBITDA. And if the interest expenditure is in excess of 30% of EBITDA, then the excess of the interest expenditure will be disallowed in the current year. Students. But don't worry, this excess of the interest amount will be added to the interest expenditure of the next year, and the combined limit of the interest expenditure of the next year, that combined limit is what will be compared with 30% of EBITDA. That combined limit is what will be, that combined limit, students, that will be compared with 30% of EBITDA. And again, if the combined limit is in excess of 30% of EBITDA of that year, excess will be disallowed. So this excess will be allowed to be carried forward for a period of 8 years, and after that it will get lapsed. And on that backdrop, students, this is a question which is there for all of us. Quickly, students, here it, have a look to the question, students, quickly. Okay, Ramkumar. So now students, let's see the proposition in this case. So here is students that you can see 2 years are given. Obviously by the reference of 2 years, always understand whenever the 2 years would be given, in that 1 year, whatever is the excess amount of interest which has been disallowed because it is in excess of 30% of EBITDA, that excess will be added to the next year, this amount. That excess will be added, students, to the next year's amount, students, isn't it? And that exactly is the point. So accordingly, they have given over here this particular proposition. So now here the gross profit has been given. Employee benefit expenditure, is it deductible in before in determining the EBITDA? This employee expenditure is deductible. Yes. So there is no problem with that. Interest which is paid to this non-resident A, this will not be deducted, students. Depreciation amount also will not be deducted. Also, the income tax portion will not be deducted in arriving at the EBITDA. So I have to determine the EBITDA my way. I have to determine the EBITDA, students, in my way. On 23rd June 2021, Rhythm Limited, an Indian company, borrowed 120 crores from M&T. I think that is what they have mentioned, the interest expenditure over there. So we know that, fine. But nevertheless, let's read this one. On 23rd of June 2021, Rhythm Limited, an Indian company, borrowed rupees 120 crore from M&T Inc. a company incorporated in country M. The said loan is repayable over a period of 4 years. This loan is guaranteed by Light Limited, a company incorporated in country Y. This loan is guaranteed by Light Limited, a company incorporated in country Y. Light Limited holds 36% shares in Rhythm Limited. Light Limited, students, holds 36% shares in the Rhythm Limited, students. Calculate the income under the head PGBP and of profession of Rhythm Limited for the assessment year 2023-24, assuming that the gross profit is calculated as per the provision of Income Tax Act and depreciation is also as per the income tax rules. Give appropriate reasons of your working. Assume none of the companies are engaged in banking business. I told you, students, because if it is engaged in the banking business, you are out from the race. Obviously, they have to exclude this particular part, isn't it? Now, if you all see, students, over here, very carefully, be careful, students, in this particular context. So, if we all see over here, students, very carefully, this 30% of EBITDA, students, in the first year. So, EBITDA needs to be calculated, students. The EBITDA needs to be calculated. So, that exactly is the point, students, in this context. Let's calculate the EBITDA then, students, in this regard. So therefore, students, in this context, out of this 2030 first year, you will less the employee benefit 390 only. That's it. No, nothing else will be reduced. So my EBITDA, students, Kalai, my EBITDA, students, Ramkumar, 1640, 1640. Now you tell me 30% of this is how much? Of 1640. Quickly, students. 353. That is 30%. And where is actual interest expenditure, students? Actual interest expenditure is how much? 562. So excess. How much is the excess? The excess, students, in this case is how much? 30% of 1640 is how much? 1640 into 30%. 492 students. It is not 353. So excess now we can say 70. Students, all of you agree? Excess can we say now it to be 70? Answer is yes, students. So excess is 70 in this case. This 70, Krishna, will be carried forward. This excess will be carried forward, students. And in the next year, let's calculate the next year EBITDA, students. Next year. The next year, students, is financial year 22-23. 22-23, students. And therefore, in that context, the EBITDA of the next year would be how much, students? The EBITDA of the next year is 1780 minus 402. 1780 minus 402. 1378. 1378, students. And that's exactly the point. So 30% of EBITDA is 1378. Now of 1378, students, take 40%. 40% of this is 413. All of you agree to this one? 40% of 1378 is 413. Sorry, 30%. 30% of 30% of 1378. So this is 30% of EBITDA is 413.4. Now the interest expenditure, students, interest expenditure. So interest expenditure in this year, if you see, is 389. 389 plus the last year is 70. Last year is 70. So the total in this case would be how much? 389 plus the last year 70, students. So the total in this particular case happens to be indeed 389 plus 70, students, in this particular context. 459. 459, students, and that exactly is the point. And therefore, how much is the excess? How much is the excess? The excess, students, is 45.6. How much is the excess, students? Somebody's this is already. Can you just be in the mute? Some Prasad. Prasad, please be in mute. So in this case, students, if you see 459 minus 413, 459 minus 413.4, which is 45.6. So 45.6, students, is what would be disallowed. And that exactly is the point, students. That exactly is the point. So this is how, students, it will be considered in this particular context. This is how, students, this will be considered in this particular context. So what will happen, actually what will happen, students, I'll tell you in this context. What will happen, students, actually in this context, 389 of the current year will be fully be allowed. Please pay attention, students, how it will be considered. 389 of the current year will be allowed fully, and out of the last year 70, out of the last year 70, how much could be allowed? See, 389 is less than 30% of EBITDA, but 389 is less than 30% of EBITDA, so the 389 would be fully be allowed. But now out of the 70, how much is the balance that could be allowed out of 70? 24.4. 24.4. So out of 70, 24.4 is what will be allowed. So that now out of 70, how much portion is not allowed up till now? Out of 70, how much portion is not allowed up till now? It is 45.6. Exactly, students. It is 45.6. I hope that now every one of you are clear with this one. Now, students, I think there are small 3 questions which are there. Ramkumar, I think we can finish it off and we are done with this one. Then tomorrow we can start with the TDS and DCS. So 3 small questions are there. Let's try to finish it off and then we can start tomorrow with TDS and DCS, students. Okay, so let's try to wrap it up. I think rather than giving a break, I think this will make more sense. Okay, let's finish it off, these 3 small questions. And then tomorrow, TDS and DCS. So questions on TDS and DCS will be done tomorrow, students. Let's start with this one. Aarti. ABC Limited, an Indian company, paid interest on loan taken from wholly owned subsidiary, PIX Inc. UK, for 25 million, students. How much? For 25 million. the TPO identified the following uncontrolled observation to arrive at this ALP. So what is the observation of the TPO, students? Let's have a look. So by the way, students, in this case has paid interest on loan taken from wholly owned subsidiary UK for 25 millions. The TPO identified the following uncontrolled observation to arrive at this ALP. Observation 1. So there are total, students, in this case. Uncontrolled. Following uncontrolled observation means comparable. So how much is the size of the comparable? Comparable size, students, is how much in this case? 6. If the comparable size is 6 or more than 6, then the range concept is applicable. Range concept is applicable. And if the range concept is applicable, then students, 35% that we have to identify the range. 35% of data set and 65%. First of all, you have to arrange the data set. Students, you have to arrange the data set in the ascending order, means from lower to higher. So the first data would be 5%. Lower rate is 5%. The second data would be 6%. The other rate is 6%. The third data in the range concept is 8%. The fourth data will be after 8, the lowest is 12%. The fifth data, students, is 14, and sixth data is 17%. So we have to arrange the data in the ascending order, and then of the total data set, which is 6, I will take 35%. So 35% of 6 in this case, students, happens to be 2.1. 2.1 means I will go to the next full digit, which is 3. At 3, students, it is 8. At 3, students, it is 8. 65% of the data set, which is 6. In this case, 65% of data set, which is 6, is 3.9. 3.9 means I take the next number 4, and of 4 it is 12. So my answer is, students, A. 35%, 8 in this case. And what about the median? So any case, 65 percentile is 12. So 8 and 12. And if I have to calculate the median, how to calculate the median? So median would be 50% of 6. Median is 50% of data set, which is 6. So 50% of 6 is 3. But 3, I cannot take up the absolute number, students. I cannot take up the absolute number, which is 8. 3 is 8. I cannot take up because 3 is an absolute number. Absolute number I cannot take. So if I cannot take 3, because up till now I used to get 2.1. So decimal. So therefore I came to the next number. Next one was 3.9. Again decimal. So I got the next number. But if there is a whole number, which is 50% of data set in my case, I cannot go with the whole number. Then whatever is the rate in that number, which is 8, and whatever is the rate in the next number, which is 12, you will take the average, which means 8 plus 12 divided by 2. So this averaging concept, students, applies in the case where the median arrives at a whole number, which is because here the even number is there 6. So 50% of 6 would be 3. Had the comparable would have been 7, then 50% of 7 would have been 3.5. And then because it is decimal, I would have taken the next number 4. But because here it is 6, therefore 50% of 6 is a whole number. And because it is a whole number, I cannot take that. So what is the approach? Approach is whatever is the ALP, whatever is the rate at that whole number, and whatever is the rate at the next whole number, you will take up the average. That becomes your median. And this is the reason why we go with this particular proposition. Question number 46, students. Let's have a look. P&N company is engaged in providing scientific research to several non-resident clients. Such services are also provided to Zeta Inc., which guarantees 12% of the total loan of P&N company. Examine whether the transfer pricing provisions are attracted in this transaction. So students, you all are aware. In this case, what is that, students? That A definition has to be referred, and as per the A definition, if the entity guarantees at least 10% or more than 10% of my total borrowing, if an entity guarantees more than 10% of my total borrowing, then this entity and the guarantor, both of them, the borrower and the guarantor, both of them will become an associated enterprise. Here in this case, it is 12% guarantee, and accordingly we will say here it is a 12% guarantee, students. Accordingly we will say that both of them are an associated enterprise. I hope that all of you are clear with this one. Now so both of them are A, and the answer is yes. Let's see what point number 2 says. Without prejudice to the answer 1 above, assuming that transfer pricing provisions are attracted in this case and that the assessing officer had made a primary adjustment of 310 lakhs to transfer price, students please understand, 310 lakhs of the transfer pricing adjustment has been made in previous year 2021, why the order dated 1st April 2022, and the same has been accepted by fee and company. What are the consequent requirement as per the Income Tax Act 1961 and the implication of non-compliance with the said requirement? Assume that the transaction is denominated in Indian rupee and no amount has been repatriated up to 31st of March 2023. The 1-year marginal cost of fund lending rate of SBI is how much? It is 9%. So students, all of you are aware of this particular part now? Every one of you. In this case, students, what is the scenario? The situation, students, over here, if you can see it very carefully, the situation, students, if you can see it very carefully, definitely, students, it is the difference is more than 1 crore, because you are saying that the primary adjustment is 310 lakhs. The primary adjustment is 310 lakhs, so difference is more than 10 crores. If that is the case, 92CE would be applicable. And what 92CE says, Piyusha? 92CE says that you need to repatriate the entire difference. You need to repatriate the entire difference within 90 days from the relevant date. And relevant date is what? Students, two important points. The two relevant dates are, which you should remember, if I have, students, if I have already made the Suomoto adjustment, if I have already made the Suomoto adjustment in my ROI, so this is a Suomoto adjustment in my ROI. So if that is the case, then the relevant date is the date of the due date. The due date, not the date of filing of the return of income. It is the due date of filing of return of income. So from that due date of filing of the return of income, within 90 days, you need to repatriate the money. Okay, but if it is not a Suomoto adjustment, if it is out of an order which is passed by the assessing officer and that order is accepted, then from the date of the order, that date of the order will become the relevant date, and within 90 days, students, you need to repatriate the money. And if you have not repatriated the money, students, if you have not repatriated the money, then the interest would be calculated herein, students, because then if you have not repatriated the money, students, then the difference, if you have not repatriated the money within 90 days from the relevant date, then the difference will be considered as a deemed loan. And if there is a deemed loan, students, if there is a deemed loan, then there would be a consequence of interest additions that would be made on your total income. Interest addition that will be made on your total income. Any interest addition, students, any interest addition that will be made will require two important particular variables. And which are those two important variables? The first variable, students, in the interest addition is the first particular variable in the interest addition is, what is the first variable, students? Indeed, the first variable, students, in the interest addition happens to be is what is the rate of interest, and second one, the interest for which period the interest would be calculated, or may I say from which date the interest will be calculated, from which date the interest calculation will be done, interest calculation will be made. These are the two variables for determining the interest amount. Now the rate of interest depends upon whether the rate of interest depends upon the transaction, whether it is denominated in foreign currency or the transaction is denominated in the Indian currency. That will decide the rate of interest. So if the transaction, international transaction, is denominated in Indian currency, then the base rate would be the SBI lending rate. SBI lending rate as on the 1st of April of the relevant previous year. Relevant previous year for 22-23 is 1st April 2022. Relevant previous year for relevant previous year would be first for 22-23 would be here 1st April 2022. So therefore, whatever is the SBI lending rate on this date, on that SBI lending rate, you will add 325 basis point, which means 3.25%. And whereas if it is a denominated in Indian rupee, INR, but whereas if it is denominated in foreign currency, then in that case, the LIBOR rate would be taken on 30th of September of the previous year. LIBOR rate on 30th September of the previous year, and on that LIBOR rate, which is the base rate, you will add what, students? The 300 basis point, which means 3%. So in this particular case, students, the interest would be of the SBI. So SBI base rate is 9% already given. As on this date, the base rate is 9%. So 9% plus 3.25. So I'm getting how much? 12.25%. 12.25%. So that I've already got it. So this 12.25% now, students, will be applied on the period. From which period the interest will begin? Now, students, if you have not reparted the money within 90 days from the relevant date, then the interest will be counted, or the interest will begin from the relevant date itself, and not after the expiry of 90 days. The interest will begin from the relevant date itself, and the relevant date, students, in this particular case is 1st of April 2022. 1st of April 2022. So therefore, you have to calculate the interest from 1st of April 2022, and the money has not been received till 31st March 2023. So tell me then, in the previous year 22-23, in this case, how much of the addition of the interest that will take place? In the previous year 2022-23, how much would be the addition of interest that will take place? So therefore, in this case, the rate would be 12.25% into the difference. 12.25%, students, into that difference amount. And the difference amount, students, as you can see, and the difference is how much? 310 lakhs. So what is the amount, students, in this case? Finally, in this case, sorry, 12.25% into 310 lakhs. What is the amount, students? Quickly. 37.97, students. So students, that exactly is the point. So I hope that all of you are clear with this one. By the way, students, are you aware that there is also an opportunity to pay the tax one time and get yourself relieved from this is known as, students, secondary adjustment. This is known as, students, secondary adjustment. Gayatri. So student, secondary adjustment is 37.975. Now, is there any option for me to get relieved once and for all from this secondary adjustment? Is there any way for me to get myself relieved from the secondary adjustment once and for all? Do we have any option to get ourselves relieved? And what is that option, students? Pay a one-time additional tax. How much is the rate of the additional tax? Naina. How much, students, is the rate, Hitesh, of the additional tax, students? Krishna. In this case, it is, students. It is indeed, Hitesh. 18 plus 12 plus 4. 18% plus 12% is a surcharge flat plus 4%, which comes to finally 20.9664%, which comes to finally 20.9644%, and that exactly is the point, students. So you pay this on the difference, you pay this 20.9664%, pay it one time and get yourself relieved completely. Get yourself relieved completely, students. I hope that all of you are clear with this one. So this covers up this two important propositions, students. Now I must tell you, students, do only one thing. Do only, if you have to revise now transfer pricing, students, your practical level probably is done. Just only read the theory part, the documentation and the penalty in transfer pricing. If you have to revise further, in this case, the documentation and the penalty, students, and that should be all for the transfer pricing particular part. So this way, students, these are the some of the beautiful questions so as to facilitate their revision in this context. And this is what, students, this case. Yeah, 20. The rate is 20.9664% to be applied on what? On the difference, which is 310 lakhs. On the difference, students. Fine. So students, this is all of it. Now, students, tomorrow we will be doing TDS and TCS. Same approach. First, I am going to quickly revise through the provision, students, of TDS and TCS, and then thereafter we will be going through the selected practical question and answer, and that is how we are going to deal with it. You then, students, in this context.